Most people are paying attention to the wrong signal. They're watching the stock market. They're arguing about inflation numbers. They're refreshing headlines about elections, rate cuts, and recession fears. But if you actually want to understand what's happening in the US economy right now, stop watching the news. Start watching the money, not prices, not opinions, not political talking points, capital. Because the biggest shifts in history never announce themselves on cable news. They show up quietly, buried in balance sheets, treasury reports, and capital flow data that almost nobody looks at. And here's the part most people miss. By the time the average person feels something is wrong, the people who move real money have already adjusted their positions months, sometimes years, earlier. Right now, something unusual is happening beneath the surface of the US financial system. It's not loud, it's not dramatic, and it's not being explained clearly. But it's changing how risk works in America. If you stay with me for the next few minutes, you're not going to hear panic or predictions. You're going to see a pattern, a way to connect dots most people never put together. And once you see it, it's very hard to unsee. Most conversations about the US economy stay on the surface. They argue about whether inflation is coming down. They debate if the Fed will cut rates this year or next. They frame everything as a short-term cycle. Soft landing, hard landing, no landing. That framing is comforting, and it's incomplete, because it treats the economy like a collection of isolated problems instead of a connected system. Mainstream narratives focus on symptoms, higher prices, market volatility, government deficits. What they rarely address is structure, how money actually flows through the system, who absorbs risk when things break, and what happens when long-term incentives stop lining up. Here's the mistake most people make. They assume stability is the default and crises are exceptions. In reality, it's the opposite. Long periods of stability encourage behaviors that quietly weaken the system underneath. Higher leverage, longer maturities, more dependence on constant refinancing, more confidence that tomorrow will look like yesterday. None of that shows up as a crisis at first. It shows up as efficiency, as growth, as everything working, until it doesn't. When the system finally adjusts, it doesn't do it gently. It reprices risk all at once. And the people who get hurt most aren't the ones paying attention to capital flows or balance sheets. They're the ones relying on headlines, averages, and reassurances that this time is different. To understand what's happening now, you have to stop asking, is the economy good or bad? And start asking, how is the system positioned if conditions change? That's the lens we're going to use. Let's ground this in verifiable facts. As of late 2025, total U.S. national debt sits just above $38 trillion, according to U.S. Treasury data. That number isn't projected, it isn't hypothetical, it's the amount already outstanding on the government's balance sheet. To put that in context, U.S. debt was under $1 trillion in 1980. It crossed $10 trillion in 2008, it passed $27 trillion in 2020, and it has added more than $2 trillion in a single year since. Debt itself isn't unusual. What matters is scale and speed. Interest payments on that debt now exceed $1 trillion per year, driven by higher rates and the sheer volume of bonds outstanding. That makes interest one of the largest line items in the federal budget, larger than national defense spending in some years. Globally, the picture looks similar. According to International Monetary Fund data, total global debt recently surpassed $250 trillion, representing more than 230% of global GDP. That's the highest ratio recorded in peacetime history. At the same time, ownership of U.S. government debt has been shifting. Foreign central banks and sovereign funds once held a much larger share of U.S. treasuries. Over the past decade, several major holders have gradually reduced exposure. China's treasury holdings, for example, peaked above $1 trillion in the early 2010s and are now hundreds of billions lower. Japan, still the largest holder, has also trimmed positions during periods of currency pressure. Meanwhile, a growing share of U.S. debt is held domestically by government-linked institutions, pension systems, and the Federal Reserve itself. On the monetary side, the Federal Reserve's balance sheet expanded dramatically after 2008 and again after 2020, growing from under $1 trillion before the financial crisis to nearly $9 trillion at its peak. That expansion coincided with historically low interest rates, elevated asset prices, and rapid credit growth. More recently, the Fed has moved in the opposite direction, allowing assets to mature without replacement, a process known as quantitative tightening. None of these facts alone signal a crisis, but together they describe a system that has become larger, more leveraged, and more sensitive to changes in interest rates and capital flows. Those are observable conditions, not opinions. When you step back and look at these facts together, a few strategic questions naturally emerge. Not what will happen next, but what incentives are now shaping behavior inside the system. One possible interpretation is that the U.S. financial structure has become increasingly dependent on continuity, stable rates, steady demand for government debt, and confidence that refinancing will always remain cheap and available. That dependence doesn't imply failure, but it does mean flexibility is lower than it used to be. As debt levels rise, small changes in interest rates have outsized effects. A 1-point increase today costs far more in interest than it did 20 years ago. That shifts how policymakers respond to stress. It narrows the range of easy options. From the perspective of large institutions, pension funds, insurers, sovereign investors, this may change how risk is evaluated. Holding long-duration assets denominated in a single currency has historically been safe, but when debt and deficits rise, diversification becomes less about return and more about resilience. This may help explain why some global investors appear more cautious, not abandoning U.S. assets, but rebalancing, reducing concentration, extending exposure to other regions, currencies, and real assets. Another interpretation involves feedback loops. When central banks hold a significant share of government debt, monetary policy and fiscal policy become tightly linked. Rate decisions affect government financing costs directly. That can create pressure to prioritize short-term stability. Again, that doesn't mean collapse. It means trade-offs become sharper. Who benefits? Borrowers with fixed-rate debt, asset holders during periods of liquidity expansion, institutions positioned early. Who faces more risk? Savers reliant on purchasing power? Households exposed to variable rates? Viewed this way, what we're seeing isn't a single event. It's a slow reconfiguration of incentives across the financial system. And those shifts tend to matter more than headlines. When financial systems adjust, the effects rarely stay contained. They ripple outward across markets, institutions, governments, and eventually daily life. In markets, higher debt and tighter liquidity tend to increase volatility. Assets that once moved independently can begin moving together. Stocks, bonds, and real estate may respond to the same pressure points. Banks feel this next. Modern banking relies on confidence, duration matching, and access to funding. When interest rates move quickly, balance sheets can become stressed. Currency dynamics also shift. When large amounts of debt exist in a single currency, confidence becomes a critical asset. Reserve currencies erode gradually as alternatives become more practical. Governments face more difficult choices. High debt limits, policy flexibility. Stimulus becomes harder to deploy without consequences. Rate hikes protect currency stability, but raise financing costs. At the global level, this encourages fragmentation. Supply chains shorten, strategic resources become politicized, the system becomes less optimized for efficiency and more oriented toward resilience. None of this implies collapse, but it does suggest a transition phase, one where the assumptions of the last few decades matter less and adaptability matters more. History shows that these transitions are rarely smooth, rarely linear, and rarely evenly distributed. Some sectors adjust early, others lag. The impact isn't felt all at once, but it compounds. Understanding that shift is essential because this is where macro conditions begin to intersect with personal reality. At some point, macroeconomic shifts stop being abstract. They show up in everyday decisions. For most people in the United States, the impact doesn't arrive as a dramatic headline. It arrives quietly, through costs, constraints, and choices that feel tighter than they used to. Savings are often the first pressure point. When interest rates rise, savings accounts may pay more, but inflation can still erode purchasing power. Money that once felt safe starts to feel less reliable, not because it disappears, but because it doesn't go as far. That gap is easy to ignore in the short term and painful over time. Investments behave differently too. Long-standing assumptions, like bonds always stabilizing portfolios or housing always trending upward, become less predictable when rates, liquidity, and valuations all shift at once. Volatility isn't just a market phenomenon, it affects retirement timelines, risk tolerance, and confidence. Jobs and income aren't immune. Higher financing costs slow expansion. Companies become more selective. Hiring freezes replace growth plans. Layoffs don't always come from failing businesses. They often come from businesses adjusting to higher capital costs and lower margins. Cost of living pressures feel personal fast. Insurance premiums rise, property taxes adjust, healthcare costs continue upward. Even households with stable incomes notice that comfortable starts requiring more calculation than it used to. And for families, this translates into long-term planning stress. College decisions, retirement timing, where to live, whether to take on debt, whether to relocate for opportunity. These aren't theoretical questions. They're life choices shaped by the environment underneath them. None of this means panic. But it does mean that relying on old assumptions about stability, predictability, or linear progress becomes riskier. The people who navigate these periods best aren't the ones who predict the future perfectly. They're the ones who adjust their expectations early and stay flexible as conditions change. To make sense of periods like this, I use what I call the structural lens. It's not a prediction model, it's not an ideology, and it's definitely not about timing markets. It's a way of thinking. The structural lens asks 3 questions before anything else. First, where is risk actually concentrated, not where it's labeled? Risk is often hidden behind familiar structures, long maturities, rolling debt, safe assets that only remain safe under specific conditions. The lens forces you to look past labels and into dependencies. Second, what assumptions must stay true for the system to keep working? Low rates, constant liquidity, stable demand, political coordination. Every system relies on assumptions. When too many stack on top of each other, fragility increases, even if everything looks calm on the surface. Third, who has flexibility and who doesn't? Flexibility is the real form of power during transitions. Governments with fiscal space, institutions with diversified funding, individuals with low leverage and transferable skills. The less flexibility you have, the more exposed you are to forces you can't control. Using this lens shifts your focus. You stop reacting to headlines and start observing pressure points. You stop arguing about outcomes and start preparing for ranges. You stop asking, what will happen? And start asking, what breaks first if conditions change? That mindset doesn't eliminate uncertainty, but it keeps you from being surprised by it. Preparing for uncertainty doesn't require extreme moves. It requires intentional thinking. The first step is awareness. Pay attention to flows, not noise. Watch where capital is moving, not what commentators are arguing about. Long-term shifts show up gradually. Second, prioritize flexibility. Avoid structures that trap you. Long-term obligations with variable costs. Third, think in ranges instead of forecasts. You don't need to know exactly what happens next. You need to understand what could happen within a reasonable range and what that would mean for your exposure. Fourth, separate liquidity from growth. Liquidity is not about maximizing return. It's about being able to act. Fifth, invest in adaptability. Skills that solve real problems and relationships built on trust are forms of capital. Finally, resist emotional extremes. Periods of transition reward patience and clarity. Panic destroys optionality. This is not about fear, it's about alignment. If there's one takeaway from all of this, it's not that something dramatic is about to happen. It's that the environment has changed. Systems evolve quietly, incentives shift, assumptions that once worked stop working as reliably, not all at once, but gradually, then unevenly. Most people don't notice the transition while they're living through it. They only recognize it in hindsight. What gives people an advantage isn't certainty, it's perspective. When you understand how structures behave under pressure, you stop being surprised by outcomes. You don't need to predict every turn, you just need to recognize when the road is no longer straight. This isn't about fear or urgency, it's about clarity. Clarity creates better questions. Better questions lead to better decisions, and better decisions compound over time. The goal isn't to outrun change, it's to see it clearly enough that it doesn't catch you unprepared. That awareness alone already puts you ahead of most people.